Central banks took center stage in March. First, it was the European Central Bank, who took a knife to economic growth forecasts, pledged some cheap funding for banks, and said they wouldn't hike rates until next year. This all came as German manufacturing data slumped the most in 6 years. Next, it was the turn of the US Fed, who also thought it would no longer be appropriate to hike rates this year, and agreed to stop reducing their bond holdings by September. Interest rates plunged, dragging German 10-year bond yields back below zero, and the US 10-year bond yields dropped below the 6-month bond yields, inverting the yield curve for the first time in almost 12 years. Inverted yield curves have historically been a reliable leading indicator for recessions, though usually with at least 1 to 2 year lead time. Developed market stocks were comforted by the cautious approach by the central banks, and the S&P 500 ended the month up 2%, leaving it 14% up for the first quarter, its best quarter since 2009. Most sectors fared well apart from banks, who typically struggle for profitability when rates head lower. In emerging markets, it was a mixed bag. Chinese stimulus continued to drive that stock market higher. The Shanghai Composite Index ended the first quarter up 24%. Indian stocks were also star performers in March, bouncing back from their early year slumps as tensions with Pakistan eased, and polls suggested a good prospect of Prime Minister Modi winning a second term at the upcoming elections. On the other end of the spectrum, Argentina delivered a fourth consecutive quarter of shrinking economic growth, sending their currency down another 9% for the month. While the Turkish lira was also off over 4% as the government depleted official reserves, trying to defend the currency amidst political and economic challenges. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.co.za or visit our website www.anchorcapital.co.za.